This program brought to you by eChoice, helping thousands of Australians find the right home loan since 1998.
Hello and welcome to Money Talks, a show that has one really simple goal, and that is to make you richer. On tonight's show, we'll make a good of our promise to talk the experts through to you to work out how scared we should be about the volatility on global markets. First up, we have Morgans chief economist, Michael Knox. Next, Julian McCormack, investment specialist at Platinum Asset Management. And then Julia Lee gives her view on the current drama and shares her hot stock for the week. And finally, the legendary fund manager, Geoff Wilson of Wilson Asset Management. He tells us how he's investing in these turbulent times. So to set the economic scene, let's head straight to Brisbane with Michael Knox. So Michael, welcome to the show.
Good evening, Peter.
Good to see you, mate. Now let's tell us this. How worried are you about a trade war between the USA and China and the implications of it?
Well, Trump has had a three-part strategy to generate an agreement with the closest trading partners that the US actually has, which is Mexico and Canada, and he's already brought that negotiation, which has been going on pretty much since he came to office, to a successful conclusion. And that will probably be passed through or ratified by the Senate during what is called the lame duck session after the midterm elections. And in that, he achieved better wages for Mexicans making motor vehicles in Mexico, and therefore that makes them less competitive with the wages, or doesn't drive down the wages of American workers making those same cars. So he did a good deal on trade and also did a good deal on jobs. Over the next year, the US will be coming to an agreement with the Europeans on automotive tariffs. At the moment, if the US exports a motor vehicle to Europe, it pays a tariff of 10%. If the Europeans export a tariff from Europe to the United States, they pay a tariff of 2.5%. Obviously, Trump wants tariffs in exports of motor vehicles and other things to Europe to be lower. And as part of that process, we then have us moving forward to China. And the real problem with China is a whole lot of firms moved to from, say, Wisconsin to Shanghai between 2001 and 2016, and with them they took the jobs of 6 million American manufacturing workers, and those jobs never came back. So the total manufacturing employment in the US fell from 18 million at the beginning of the century to 12 million in 2012 and kind of stabilised there. And the reason that was that as China came into the World Trade Organization, the low tariffs it enjoyed for exports to the US were permanent, permanent low tariffs for Chinese exports to the United States, and that made it economic for US firms to move to China and export back to the United States. Well,
okay, but
Trump, by moving around...
Cut to the chase. Do you think there's going to be a trade war USA-China?
No, I think there's an extended negotiation. Yep. I think he's already won the first part by moving the tariffs around. Yep. I think he'll move now into the automotive tariff negotiations. Yep. Over a long period of time, though, they've got to renegotiate a new regime on intellectual property because Peter Navarro, who's their trade expert says the Chinese have been stealing their intellectual property, and hey, that's not fair, and they've got to come to a different agreement about that.
Okay, so let's go to the next scary question. US recession, when do you think it happens? And be right.
Well, yeah. Well, I did a talk about this about a week ago, and I said there are two really important indicators in the US. One, for financial markets. One is the one we've talked about over the years so many times, Chicago Fed National Activity Indicator, and for it to be the level which signifies a bear market, not necessarily a recession, is about 0.4 of a standard error below long-term trend, and right now it's about 0.2 and a bit of a standard error above the long-term trend. So right now the US economy is booming. If it goes into an extended slowdown, as it may be by end of 2019 or 2020, maybe, then we've got a chance of a bear market. But what the Fed is actually targeting is what's called a soft landing or growth recession, where growth is soft, but still above trend, but unemployment goes up to, you know, from 3.5% to 4.5%, something like that. That's what they're attempting to achieve. We'll find out if they do.
Knoxy, as always, thanks for setting the scene, mate. We'll talk to you later. That's Michael Knox, Chief Economist at Morgans. So Julian McCormack now joins me from Platinum Asset Management, and you guys are famous for investing in Asia. Are you comfortable with what Michael Knox said about the trade war?
Yeah, pretty comfortable. So let's put the numbers in context. You know, when Trumpy really gets aggressive and he says we're going to put tariffs on all 500 billion, it sounds like such a big number. It's scary, right?
Right.
Except the Chinese economy is 12 trillion. So
That's a good point.
It's 0.5 over 12, and now let's slow the growth of the 0.5 to 0. It's pretty irrelevant, right? So there is a broader effect. So let's say we run a factory in Guangzhou, and now we have to make a decision about next month's inventory or whether to invest in plant and equipment. That is getting affected. That is getting affected.
But given that, and I understand that, and I think you explained it very well, but we know that the Chinese markets in particular have sold off really strongly.
Yeah.
And so do you and the team at Platinum think it's an overreaction and therefore we're probably looking at a buying opportunity at some point in time?
Yeah, it looks like it. It looks like it. So the local guy is very, very bearish. So let's just set the scene around this as well. We've had credit controls here for years, so sort of 7 years. Now that was initially to heavy industry, but now it's to small and medium enterprise and mums and dads. So they're feeling that. So the everyday local Chinese person's feeling that. So, and there are rumours there about the yuan going to 15 to the dollar. It's at about 7 now. So that's crazy, crazy stuff. So they're very bearish, and foreigners, well, look, they don't really care because they're not really there. So there's not really a marginal buyer there, except that this market rips when it goes. So it looks cheap. It's on about 9 times earnings, and earnings look like they're growing at 15 or 20.
And if we had a chart, but what our viewers would see was a massive fall-off.
Big fall-off, yeah. 25% this year.
And it's amazing you've retained your hair very strongly. I've always been more worried than you.
Yeah.
But to me, because the trade war's not settled, the midterm election's not out of the way, it seems to me it still looks a bit like a falling knife, hard to grab it right now. But do you think it's close to that knife hitting the bottom soon and starting to vibrate? Yeah,
well, we've been here before. So there's been so many of these episodes over this whole bull market, right? So we've had Italian banking crisis, Chinese debt crisis, Brexit, Grexit, whatever. Now, all of those felt pretty bad.
Rocket Man as well, I guess.
Yeah, little Rocket Man. So all of these things have made you feel queasy, except you just wanted to buy cheap assets well. And that's what this market's giving you. By the way, it's not just regional, it's sectoral. So if you want to go and buy cyclical assets now, it is so cheap to do so. So it's not. It's actually all things that leverage global growth. So automakers, home builders, machine tools, oil and gas.
All in the Asian setting, you're saying?
No, globally.
Globally.
So you can go and buy BMW right now on about 7 times earnings, 20% of market cap in cash, about a 7% dividend yield. This is BMW. It's pretty good.
Pretty good. US recession, when are you and Kerr and the team thinking that would be the the threat to this? Because the global environment is the tune's been set by by Wall Street and Donald Trump.
To a degree,
right?
To a degree. I mean, you know, we do have very big economic blocks now, independent of the states.
Okay.
The states is about 23% of global GDP, so we have a bit of a recession there. Let's say that Europe keeps accelerating because it's growing quite nicely.
Is that the view from
Well, it looks like it.
Okay.
It looks like this is a place that's, you know, you've got loan growth picking up off very low levels, loan losses picking up off low levels. You've added 2 million jobs in about a year.
Yeah.
This place looks like it's going pretty well, and there's no fanfare about it, so it's not very popular. And Asia looks pretty good from here prospectively, right?
So, Julian,
could be interesting.
So what you're really saying is that there is reason to be scared about the temporary problem around the trade war and implications on markets, but the longer view makes you feel positive about stocks. You don't think what we've seen over the last week or two is a prelude to something bigger and scarier that my viewers should be worried about?
Could be bigger and could be scarier. So there's one area of the world that we're pretty wary of, and that is US corporate profitability, particularly in tech.
Right.
So that could really scare people.
Right. In relation to their share price?
Absolutely.
Yeah, because their profitability is okay if the share price wasn't so silly, but the share prices are really high.
If you want to be a student of history and look back at markets, you know, if you go back into the 60s, you were buying wonderful firms like IBM and EDS and Polaroid and Kodak, Westinghouse. And if you held those things through the early 70s, you were down 90%. Right, so I'm not saying that's going to happen. I'm just saying really good firms can get really bid up and have big setbacks, and that will make people feel very queasy. But does that really affect the number of BMWs that BMW will sell globally? Not much.
And it sounds like a very strong argument for diversification. If you're sitting purely on tech, that's probably a pretty scary place to be.
Yes, and it's driven markets, absolutely. So year to date to September, the top 10 stocks that have given you, most of your return are on a PE of about 40 globally.
That's big.
That's big, and they're all US firms, by the way. 7 of the top 50 this year are outside of the US. So you just do want to be a bit wary of having too much concentration there.
So let's imagine someone really close to you who you loved and you didn't want to let down said to you, Julian, what is your best investment idea right now?
There's actually so many. So cyclicals globally. So, complex oil and gas refiners. There's a whole series of International Maritime Organisation rules coming in. Those high margin autos are high margin because they've got to deal with EVs. Chinese insurers look amazing. There's so many.
Okay, but I'll push you on the spot.
Yes.
What is the fund that you guys have that you like the most, given what has happened? Which one looks the best? To spring back the best, come on.
So I like our brands fund. Our brands fund. So it's an international brands fund. It buys businesses globally that leverage the consumer. So that for us means Asia.
Okay, and it's called?
The International Brands Fund.
International Brands Fund. Okay, you heard it here first from the man who nearly runs the show.
Really, yeah.
But it's the one you like. Great
That's
stuff.
the one I like.
And clearly you're not scared, you're just cautious.
Yeah, exactly. We hold about 20% cash across most portfolios, so we're a little bit cautious, but not scared.
Okay, thanks, Julian. That's Julian McCormack from Platinum Asset Management. Stay tuned for Julia Lee. Hot stock picks of the week coming up. I'll also ask her if she's a little bit toey about what's going on in stock markets. Welcome back to Money Talks. Now, if the banks and financials haven't been given enough scrutiny, here is Julia Lee's examination of the facts. Julia, thanks for coming on the show.
Always a pleasure.
Quickly, how worried are you about the volatility you're seeing on the stock market right now?
I think volatility is just normal, and I think we got used to the lack of volatility on markets, and that's abnormal. I guess the bigger problem is trying to work out when we move from the part that's very good for the equity markets, which is rising inflation, rising growth, to the part that's a bit more difficult for the equity markets, which is rising inflation but slowing growth. And I think that's why earnings season in the US is so important. We've seen...
and we're in that now.
Absolutely. We've seen 5 out of the 6 quarters seeing double-digit growth in earnings out of the US, which is absolutely absolutely phenomenal. And it's the US which has been driving those global returns. The MSCI index last year was up by 20%, and the large portion of that was the US market.
Yeah, and that's like, for people to understand, that's like an international index of top companies, isn't it?
Yeah, and I think as we get to the later cycles of the bull market, there's one of two things that happens. If you're a longer term investor, you move to more defensive strategies, or if you're not mindful of time frames, the time frames
young and aggressive like you, Julia. Okay,
time frames get shorter.
Okay, well, on the subject of defensive, you like banks at the moment?
Yes, for a shorter term trade, banks are looking good. I think they have been oversold. And look, there's not a lot of times where we do see bank yields at where they are at the moment.
ANZ, was that?
6.2% fully franked, if the franking does remain.
Yeah, that's a good point.
At just under 9%, and Westpac's even higher than that, at around almost 7%. And then if you gross that up,
do you think a lot of people are a bit scared? They don't know what the government might decide to do post-Royal Commission, and therefore they've actually oversold them, do you think?
Look, the share market is an amazing thing where it prices in new information, and a lot of the risks that we know are a slowing housing market. We know that there's going to be extra costs related to compliance and regulation because of the Royal Commission. So you need new information to come to light. At the moment, we've seen the banking shares absorb a lot of that bad news, and in fact, the big four banks are down 14 to 20% over the last 52 weeks. I think they have gone a bit too far here, and the market does tend to overreact. And there is an opportunity in November because 3 out of the big 4 banks do pay their dividends. So I'd be moving to ANZ as my top pick, but also NAB and Westpac pay dividends.
And we're coming up to their unusual reporting season. They kind of report out of sync. A lot of people are surprised about that. What are we expecting to see?
I guess when you have a look at the banks, at the core of their business, they basically take deposits and then they lend out money. So they're managing that spread, which is why something like the net interest margin is important. But they also are quite cyclical, and we haven't seen a recession here in Australia since 1992. So the banks are leveraged to the economy. So one of the things that I keep a close eye on is the bad debt cycle, because the bank's share prices are closely tied to that. At the moment, credit quality is good, but keeping an eye on the property market, which is such a large part of the bank's book. So look, long term I'm a bit more negative, but short term I think there's an opportunity.
Yeah, and we will hear in November from how many banks?
3.
3. And they will be telling us basically how they're doing.
Yeah, and look, I think most of the bad news is already out there. We already heard of provisions coming through from Westpac as well as from NAB. So look, I think the market already knows those provisions related to the Royal Commission.
Do you have a view on any other financials? You've talked about basically the big 4 banks. Any other ones you have a view on?
Well, longer term, the banks are struggling to find that earnings growth. But Challenger, they're forecast to grow their profit before tax by 8 to 12%. The annuities business is going really well. In fact, they had their second highest record quarter in terms of annuity sales. And I think we saw Australian annuity sales up by around about 21%. And there's a new exciting product coming up, which is deferred annuities. So most people are scared that they're going to run out of money before before they die before the super fund. So this sort of kicks
they live
in
beyond the super fund,
This kicks in at a certain age, so you buy a deferred annuity that kicks on maybe after 80, so that you have enough money to survive the rest of your life.
Okay, and Challenger has been beaten up recently, so it's in the buying zone as well?
I think it is in the buying zone. It has this strategy where it's partnering up with a lot of distribution platforms. The latest, I think, was Hub24 and Netwealth, and I think that distribution strategy is working.
Without a doubt. Julie, as always, great information. Thanks very much.
Thanks,
Julia
Pete.
Lee from Bell Direct. Coming up after the break, Geoff Wilson of WAM updates us on how he's investing right now. Welcome back to Money Talks. I'm joined by someone who's been, and I think has seen, many scary moments on global stock markets. That's Geoff Wilson, the founder of Wilson Asset Management. So let's just see how concerned he is right now. Geoff, how are you?
Good, thanks, Pete.
Now, I know you're usually looking very relaxed, even during scary moments. Are you scared at the moment?
Definitely, yeah. I mean, where are we in the cycle? The US, it's the longest bull market ever. So we are at the very mature stages of the bull market. And one thing we do know is what happens after bull markets, we get a bear market. And we all know that is very painful for anyone who invests in the market.
Yeah. So, but are you saying to yourself, you expect the turning point to be soon, or are you more on line with the Economist Intelligence Unit 2020, Goldman Sachs 2020? Is that more logical to you?
Like it's nearly impossible to guess or look at anyone's crystal ball.
Yeah.
You know, we've got two really good leading indicators. One tells us that it's happened, that it's effectively 1 second to midnight, and the other one tells it's got about a year or a year and a half to go, and that sort of lines up with those other two. But I mean, one thing we do know is it'll be painful. Yeah, it's always different. Yeah,
the last one was pretty bad.
Oh yes. Yeah. And I mean, there's been enormous liquidity being pumped into the system, and the scary thing is that coming out. You know, one thing that I'm really watching is the inflation in the US, and with record low unemployment over there, and money supply, which a week or two ago was growing quite strongly, was a real concern from my perspective. And over the last lot of numbers we saw last week, the Fed was actually buying, taking a lot of liquidity out of the system, and the money supply the growth wasn't as strong. So that sort of tempered the inflation outlook. And to me, it's inflation going up, interest rates going up, and price earnings multiples, say going from 20 to 15 times. And
well, the question I always ask you is how much cash you're holding.
And we'd always say we're holding a lot, and it's about 30%. So, but our average.
I've heard you say 40%.
Exactly, yeah. Our average, I mean, it is a reasonable amount. Our average over 20 years has been about 34%. Yeah. So we're a little bit under, but that's more some more short-term opportunities. So, but we are very nervous.
Okay, in terms of the Australian market,
yes.
Do you look at the banks and say to yourself, I know they've got their problems, but they still look oversold, or do you think they're pretty well right?
The problem is when we try to buy undervalued growth companies, and we try to buy them when we're going to see a catalyst. Now, I mean, the banks would come in a different category. They are fantastic franchises. Obviously, they've been beaten up significantly with the Royal Commission, and from a sentiment perspective, everything's been tough. And economically, in terms of their fundamentals, things are difficult. If we have a pick-up in bad and doubtful debts, then which we're not seeing at this point in time, but it is obviously a risk. And their funding costs, we've seen they've had to put up rates. Their funding costs has been a negative, but also the bigger negative is probably what's happening with the property market. And we think we're hearing some deals that have been done on property, overseas buyers that have been desperate to find some cash. I suppose my view is that the property market is probably softer than we're reading in the paper, even though we're reading quite negative things in the paper, and so that's probably a bit of a headwind for the banks. So we're in WAM leaders where we can own them, and we are well underweight.
Okay.
At some point in time, we'll upweight, but not just yet.
Well, you mentioned the word short term, and I
thought you said Shorten.
I thought you were talking about Bill Shorten.
No.
Are you afraid of what the implications of the impact on retirees and the tax refunds, and the imputation credits? Because you have gone public on it, you are concerned, aren't you?
Oh, incredibly concerned.
Now, why are you concerned?
Well, to me, it's one of the most unfairest changes to the tax system I've ever seen. I sat down with my accountant a few weeks ago, just going through my super fund, and luckily I've been fortunate enough to do reasonably well in my super fund.
Gee, you think so?
Well, and the impact of the changes that they're talking about is will have no impact on me personally. And the people it's impacting on is retirees, self-managed super people they've done the right thing all their life. Women, low-income earners, the middle and low-income earners. It is just appalling. Like some of the stories that I've seen. We've got a petition on our website, and we've had over 23,000 people have signed up.
And you want more, of course.
Oh, exactly. And to me, the interesting thing is, I believe Labor will crack, and I believe we saw the first signs on the weekend. And you wouldn't assume that. All the headlines were the drubbing that Liberals got. Effectively, the people that normally vote for Labor last time in the Wentworth by election, and that was, you know, is not a big figure anyway. They've lost 6% of those people. They voted against Labor. Now, you'd think Labor would have got a swing to them. And to me, the reason why they got a swing against them is because what they're doing, you know, to all those low and, you know, middle and low income earners, you know, to me, it's appalling.
Look, we are out of time, mate, but
yes.
if the Labor were candidates and said, look, we'll put a cap of 30,000 tax-free refund, and above that you don't get a refund, would you think that's fair?
Well, we'd have a look at it.
Okay.
Yeah.
Great stuff, mate. Always good to see you.
Thanks, Pete.
That's Geoff Wilson, the legendary Geoff Wilson from Wilson Asset Management. That's the show. Thanks for joining us. I'll see you next week.
This program brought to you by eChoice, helping thousands of Australians find the right home loan since 1998.